Video tutorial we talked about financial statements. In this video tutorial we are going to talk about what the financial statements can reveal, and we're going to find out what they can reveal through financial ratios. These figures are they come from the financial ratios are figures that are derived from the three major financial statements. And investors will use these ratios to be able to gauge the company's profitability, liquidity, and their debt coverage, or their if they can cover their financial flexibility. The financial ratios are derived from the three major financial statements. They are derived from the balance sheet, the income statement, and the cash flow, the statement of cash flows. And they can be used as a detailed analysis of the company. And investors will be able to gauge a company's profitability, their liquidity, and they'll also be able to see whether a company can cover their debt obligations through these financial ratios. And ultimately, most of the figures from the financial statements are somewhat related. And through these specific financial ratios, you can identify trends in these relationships. So let's look at liquidity ratios. And liquidity ratios, they basically measure a company's ability to meet short-term obligations or current debt. And the two main ratios involved in liquidity are current ratio and quick ratio. Current ratio measures short-term debt paying ability, and quick ratio measures the immediate short-term debt paying ability. And current ratio is equal to current assets over current liabilities. And of course, if we wanted to find out a company's current assets or their current liabilities, we would have to look on the financial statement, the balance sheet, because the balance sheet is the financial statement that has assets and liabilities. So what we would do is we would go to the balance sheet and we would pull out the current assets, and we will pull out the current liabilities, and we would divide current assets by current liabilities, and that will give you your current ratio. So let's look at a current ratio example. Let's say, for instance, you're researching a company and you notice that they have $1 million in current assets and $2 million in current liabilities. So if we were to put the current ratio formula together, current assets over current liabilities, we would come up with 0.5. And what this essentially means is that 50 cents, this means that the company has 50 cents for every dollar of current debt. So in essence, if the company was to cash out all of its current assets, they would still have $1 million still left in current debt. And this doesn't even include long-term debt. The quick ratio, it deals strictly with cash or extremely liquid assets like stock. And the quick ratio can give you a more accurate read on a company's ability to repay current debt. Quick ratio is cash, securities, and receivables divided by current liabilities. An example of the quick ratio, let's say the company has a total of $2.5 million in cash, securities, and receivables, and it has $1 million in current liabilities. So if we was to take that figure, $2.5 million, and put it over $1 million, or divide it into $1 million, we would get 2.5. And what this means is that you, or the company, has $2.50 in cash, essentially, for every dollar of current debt. So if the company was to shut down operations and pay all current debts, they would have $1.5 million in cash left over. Alright, so let's look at activity ratios. And activity ratios, they measure how well the company is using assets in regards to sales. And the three major activity ratios include accounts receivable turnover, inventory turnover, and total asset turnover. And the first one that we are going to look at is accounts receivable turnover. Accounts receivable turnover is equal to annual sales over accounts receivable. And you would get your annual sales from the so you are getting two different figures from two different financial statements. You're getting the annual sales from the income statement, and you're getting the accounts receivable figure from your balance sheet. Now, the higher the turnover figures, the better. So a company, let's say a company has a sales of $50 million and they have $20 million in accounts receivable. Well, this means that the company is turning its receivables 2.5 times a year. And this figure also means that the company is generating 2.5 or $2.50 in sales for each dollar invested in receivables. Okay, so now we're going to look at inventory turnover. Inventory turnover is equal to annual sales over inventory. And you get the annual sales figure from the income statement, and you would get the inventory from the balance sheet, because inventory is an asset. And the higher the inventory turnover figure, the better. And inventory turnover would be of great importance if you are researching a retail company, a company that is involved in retail. And this figure will let you know if management is aware of what their customers are looking for. So let's look at this. A company generated $24 million in sales and has $2 million in inventory. And so if we was to put this into the inventory turnover ratio formula, we would do $24 million over $2 million, and that would give you 12. And so what this means is that the company is turning its inventory 12 times a year. And so if you look at that figure a little bit more deeply, you will see that the company is holding inventory for just a little over a month, for about 30 days each month. And we get that by dividing 365 days by 12, and that will give you 30 days. And so the higher the inventory turnover, the less time that an item is in the back room or the warehouse, which means less cash is tied up in that particular item. If you have a situation where you're researching a company or a retail company and it shows that their inventory turnover is low, then there's a problem. That means that the retail company is not purchasing items that the customer wants, because they're not generating sales with the inventory that they have. Alright, so total asset turnover. Total asset turnover is equal to annual sales over total assets. And once again, we get the annual sales from the income statement, and we get total assets from the balance sheet. And the higher the total asset turnover figure, the better. And this figure measures how well assets are being used to generate sales. So let's say that a company generated $2 million in sales, and they have $1 million in total assets. And so what this means is that for every dollar invested in assets, $2 in sales is being generated. Alright, profitability ratios. The profitability ratios measures a company's profit in relation to its sales, assets, and equity. And the most common profitability ratios are a net profit margin, return on assets, return on equity. So let's look at net profit margin. The profit margin is the net income over annual sales, and we get both of these figures from the income statement. And net profit margin measures profit as a percentage of sales or a percentage of revenue, and clearly it's favorable to have a higher profit margin. A company that has a net income of $2 million from $5.5 million of sales. If we were to put these two figures together in the net profit margin formula, we would put $2 million over $5.5 million and we would get 0.36 or 36%. And this means that for every dollar in revenue, 36 cents in profit is generated. Or for every dollar in revenue that we make, we keep 36 cents. Return on assets is the net income divided by total assets. And once again, you would get the net income figure from the income statement, and you would get the total asset figure from the balance sheet. The balance sheet has assets and liabilities, and the income statement would have the net income. And the return on assets, that measures the profit as a percentage of the assets. And it tells us how well a company is using its assets to generate profit. And the higher that this number is, the better. So a company generated a net profit of $2 million and their total assets amount to $50 million. So in this particular case, the $2 million in sales, we will put that over the $50 million that they have in assets, and we come up with 4 cents or 4%. And this essentially means that the company is making a profit of 4 cents for every dollar invested in total assets. Return on equity. Return on equity or return on investment is net income divided by stockholders' equity. And the net income figure is derived from the income statement, and the stockholders' equity figure is brought about from the balance sheet. Remember, stockholders' equity is assets minus liabilities. And basically, return on investment or return on equity is a measure of profits as a percentage of the shareholder equity. And it tells us how much a company makes for every dollar of stockholders' equity. Return on investment, return on equity is what every investor is looking at, and it's ideal that the company's return on investment or return on equity is increasing year after year. Example of return on equity: the company generated a net profit of $4.5 million and the total stockholders equity is $46 million. So in this particular case, we would put $4.5 million over $46 million in stockholders equity, and we would come up with 0.097 or 9.7%. And this means that for every dollar invested in the company, the company made a profit of almost 10 cents. So now let's take a look at coverage ratios. Coverage ratios are financial ratios that measure the amount of debt financing being used to support operations and the ability of a company to service its debt. And there are two major ratios used in this category. There's debt to equity ratio, and there's times interest earned. The debt to equity ratio is the total debt or total liabilities divided by stockholders equity. And the debt to equity ratio measures the amount of financing provided by lenders and shareholders. And companies can raise money by issuing stock, or they can raise money by securing a loan from a bank. And it's not unusual for companies to use a combination of debt and equity financing. So let's look at an example of debt to equity ratio. Let's say a company has $400 million in total debt and the stockholders equity is at $100 million. Okay, so we put $400 million over $100 million and we come up with 4 or 400%. And basically what this means is that this company has $4 worth of debt for every dollar of equity. Using financial ratios can help you quickly identify negative or positive trends within a company. Financial ratios, they're divided into 4 major categories, and they highlight a company's liquidity, activity, profitability, and coverage. And one thing that I want you guys to know is that you do not have to be doing all of these crazy calculations when you're researching a company. All of these ratios are pretty much given to you when you're doing research on different companies on these different websites that I gave to you and where you can find information on companies. What you do need to find out is what ratios are normal to a certain industry. If you are investing in retail, then you need to find out what is the normal profit margin for all retailers or retailers in that particular sector. If you are investing in an insurance company, then you need to find out what is a normal profit margin in insurance companies or in a sector, in that particular sector of insurance companies. You need to know what ratios are normal to your particular industry, and that will help you make a smart and educated business decision or investment decision with regard to investing in stock.